Greetings, dear participants of the 2024 Soros Dubai International Conference on Interdisciplinary Research in Social Sciences. My name is Dzaky Dharmawan, and I'll be presenting about my bachelor thesis titled Determinants of Underpricing in the Indonesian Market. Okay, here's a little about myself, and here's my email if you wish to further inquire about this topic. I'm a double degree student from Bandung Institute of Technology in School of Business and Management, majoring in international business, and also part of the University of Groningen Faculty of Economics and Business, also majoring in international business. And here is the table of content for this presentation. First, we go to the research background. Underpricing is a phenomenon of selling newly issued shares at price below their intrinsic value and is one of the IPO anomalies observed alongside long-term underperformance. Pradhan and Shrestha and Banerjee et al. Demonstrate that underpricing is prevalent globally, with examples from the United States and also from other developed economies such as Netherlands, Switzerland, and Canada, and also from emerging markets such as Nepal. The setting of my research paper is in the Indonesian market, because Indonesian market is a relatively young market and is experiencing a rapid expansion, in which they saw 311 IPOs in the last 5 years. And understanding underpricing phenomenon in a young and growing market is a crucial addition to the literature surrounding IPO underpricing. For the research gap, this research introduced contemporary determinants such as COVID-19 pandemic and internationalization in the Indonesian market setting. These determinants have been largely absent from a lot of papers discussing underpricings in the Indonesian market. For the research question, the question is, what are the determinants of IPO underpricing in the Indonesian market? And here is a list of variables. As you can see, there are 6 independent and 1 dependent and 1 moderating variables that will be explained further. And now we move to the hypothesis development, starting from the first independent variable, which is firm age. BD and Reader proposes that firms facing greater ex-ante uncertainty exhibit higher underpricing in IPOs. Identifying a risk proxy highly correlated with ex-ante uncertainty is crucial. Firm age serves as a prominent proxy, with older, more established firms experiencing lower underpricing due to reduced risk. Ritter and Lauren study across periods confirm that younger firms consistently have higher initial returns than their older counterparts, reinforcing the link between firm age and lower underpricing. Firm size is the second independent variable and viewed as a proxy for ex-ante uncertainty, just like firm age. According to information asymmetry theory, uninformed investors demand greater compensation for shares with higher uncertainty, leading to greater underpricing. Past research, such as Ibbotson, supports a negative correlation between firm size and underpricing. Switzer et al. Study on 4,628 IPOs in the Canadian and American markets from 2006 to 2016 affirms that smaller firms experience higher underpricing, 19.32% compared to 13.887 compared to their larger counterparts, 12 and 8.83% and 10.09%. This empirical evidence underscored the role of firm size in determining underpricing, which leads to the second hypothesis, which is there's a significant negative relationship between the firm size and the level of underpricing. The third independent variable is board size. There is a general consensus in the literature that board size decreases the underpricing of IPOs. Carter et al. And Serto et al. Discovered an inverse relationship between board size and initial day underpricing, because potential investors view larger boards as a signal of increased access to resources. Boone et al. Also proposed that larger boards can provide optimal monitoring when managers have ample opportunities to engage in self-serving activities. Which leads to the third hypothesis. There is a significant negative relationship between board size and the level of underpricing. For the fourth independent variable, which is financial leverage, previous studies emphasize information asymmetry between insiders and outside investors in financial structures. Leland and Pyle note insiders possess superior knowledge about their projects, and Ross introduced signaling models, suggesting firms strategically use higher debt levels to signal confidence in growth. Applying this to IPO, James and Weir proposes that issuing private debts before stock issuance signals high quality, reducing asymmetric information and lowering underpricing. Shannon finds that pre-IPO banking relationships similarly mitigate asymmetric information issues in IPO underpricing, which leads to the fourth hypothesis: there is a significant negative relationship between financial leverage and the level of IPO underpricing. For the fifth, for the fifth independent variable, which is internationalization. Internationalization in business often yields both costs and benefits, with literature generally highlighting positive effects. Firms engaging in international activity prior to an IPO experience lower underpricing attributed to global diversification and benefits. This expanded reach stabilizes revenue and enhances brand recognition, reducing uncertainty for investors. Studies by Maurer et al. And Ozdemir and Ubneja support this, showing internationally diversified companies command higher valuation, resulting in lower IPO underpricing. Peng et al. Specifically found that Chinese IPOs with exports exhibit 12.6% less underpricing, signaling quality investment and improved corporate governance, which leads to the fifth hypothesis that stated there is a significant negative relationship between internationalization and the level of IPO underpricing. Now to the sixth independent variable, which is the tech industry. So most tech firms are young and operate in a rapidly evolving environment with changing regulations leading to high uncertainty. For instance, internet stocks being relatively new exhibits higher underpricing, attributed to investment bank uncertainty in evaluating them. The practice of underpricing is essential for smaller tech IPOs due to limited historical information, stimulating investor interest. This aligns with theoretical considerations and previous empirical findings, which leads to the sixth hypothesis that stated there is a significant positive relationship between firms in the tech industry and the level of IPO underpricing. And now we move to the moderating variable, which is COVID-19. Amid the COVID-19 pandemic, extensive academic research delves into its impact on various financial sectors. Studies on equity, debts, derivatives, and commodities, cryptocurrencies, banks, and institutional investors indicate a consensus that pandemic-induced uncertainty and government responses negatively affected market quality and performance. IPO markets experiencing increased information uncertainty saw nearly 9.3% higher initial returns during the pandemic. This aligns with BT and return notion that higher uncertainty leads to increased IPO underpricing. Baker and Chen confirmed greater uncertainty in pandemic-era IPOs, particularly in high-tech and healthcare sectors. Empirical evidence suggests that firm-level characteristics like higher leverage during pandemic correlate with increased underpricing, which leads to the seventh hypothesis, which is firm leverage effects during COVID-19 pandemics are expected to exhibit higher underpricing compared to firm leverage effects during the non-COVID-19 pandemic. And now, here is the conceptual model. As you can see, we move to data and methodology. So this research focuses on Indonesian IPOs from 2016 to 2022, aiming to analyze recent events, including pre- and post-pandemic situation. A total of 327 IPOs were identified on the Indonesian Stock Exchange, with 277 meeting criteria after filtering for sales data availability from Orbis database. These IPOs are categorized into 9 sectors by the Indonesian Stock Exchange, which includes consumer cyclical, consumer non-cyclical, financials, technology, basic material, infrastructure, properties and real estate, and transportation and logistics, and healthcare. For the dependent variable, underpricing will be proxied by initial returns. Initial return can be calculated as first day gain multiplied by the numbers of shares sold. and can be computed as follow, where IR, or the initial return, is the underpricing or the initial return of a firm, and PI1 is the closing stock price at the end of the first day trading, and PO is the offer price per share of the IPO issuing firm. And here is the list for the independent variables. So the firm age will be measured as the difference between the year of the initial public and the year of company incorporation. Firm size will be represented by the logarithmic value of the firm's total assets. Board size is the number of individuals holding board positions. Financial leverage will be measured by the debt to equity ratio in the IPO prospectus. Internationalization will be obtained from the Orbis database, and the measurement is from 0 to 1, which is the foreign sales to total sales ratio. Tech industry will be a dummy variable, one indicating that the company is from the tech industry and 0 from other industry. And the emerging variable is COVID-19 will be represented by the dummy year variable for the year of 2020. Here is the data and the model specification. As you can see, there is two model specification because we'll be conducting two tests. The first one is just including the independent variable, and the second will also include the interaction effect between COVID and the financial leverage. And here's the result. There's the table on the right. So model 1 shows that firm age are significantly reduces underpricing, while total assets and board size are insignificant. In model 2, debt to equity and foreign sales ratios are introduced with both considered insignificant. Model 3 adds a tech industry dummy, insignificantly affecting underpricing. Model 4 emphasized 2020 as a symbol of COVID-19's impact, revealing significant underpricing increase for 2020 IPOs. Notably, Model 4 has the highest R-squared and adjusted R-squared values, making it the optimal regression model. And here is the second table with the interaction effect. So in Model 1, financial leverage, the 2020 year factor, foreign sales ratio, and their interaction are introduced. Only the 2020 year variable is significant, negating increased underpricing during the pandemic. Model 2 includes firm characteristic, with age significantly reducing underpricing. Model 3 adds a tech industry dummy, but none of the variables are significant. Model 4 from the previous table remains overall best, with the highest adjusted R-squared value at 0.1063, chosen for hypothesis interpretation and econometric analysis. So for the discussion, this study confirmed that firm age significantly influences underpricing levels. Consistent with prior research, this research also established a positive association between COVID-19 and underpricing, reflecting heightened uncertainty during pandemic. Surprisingly, the pandemic morting effect on financial leverage proved insignificant, challenging previous expectations. However, both sides, internationalization, tech industry involvement, firm size, and financial leverage display insignificant influences on underpricing, suggesting these factors may not strongly signal IPO firms' quality to an investor, which means that only the first hypothesis is not rejected, while hypothesis 2, 3, 4, 5, 6, and 7 is rejected. And for the theoretical implication, the finding that firm age has a significant negative relationship with underpricing and COVID-19 pandemic, significant positive relationship with underpricing, serve as empirical evidence and validation of existing theory on IPO underpricing, especially information asymmetry, as these findings prove that firms with solid firm characteristics are easier to evaluate and induce less information asymmetry during high uncertainty periods like COVID-19 pandemic, which leads to higher information asymmetry. These findings serve as empirical evidence that higher or lower information asymmetry leads to higher or lower underpricing. For the managerial implications, firms' manager could use findings in this thesis to better their IPO performance and avoid high underpricing levels in their IPO. And firm age significant negative relationship with underpricing could be explained by less information asymmetry and uncertainty. So as firm age, they accumulate more experience to develop stronger internal controls and build better relationship with investors. This can help reduce information asymmetry, which ultimately give investors more confidence in their investment decision. This can lead to lower underpricing as investors are less likely to demand a premium for perceived risk. So, if a firm manager wants to reduce costs when they want to undergo an IPO, they must reduce information asymmetry by providing better quality information to the investor. For the limitation or recommendations in the sampling data of this research, foreign sales data is applied to assess the degree of internationalization. However, many firms in the financial industries are omitted because of that. Banks dominated the financial industry in the Indonesian market, and they also seem to have no available sales data in Orbis database. So the omission of many banks IPOs in Indonesia may affect the result of the study and hinders this research ability to fully reflect underpricing phenomenon in Indonesia. It is recommended to adjust the variable that will enable the inclusion of as many IPOs in Indonesia as possible, especially the inclusion of bank IPOs, so that the future research may be able to better explain the underpricing phenomenon in Indonesia. So here is the conclusion. This thesis investigates IPO underpricing determinants in Indonesia, proposing 6 factors. Empirical evidence reveals only firms' age are significantly predicts underpricing. Older firms are viewed as more established, reducing information asymmetry and prompting investors to demand less money on the table. This information can aid managers in reducing IPO costs by improving information quality. The exclusion of financial firms, particularly banks, may impact the study accuracy, urging future research to include variables involving banks for a comprehensive understanding of underpricing in the Indonesian market. I hope you find the information in this presentation enlightening, and thank you for your attention. If there is any further inquiries, you can contact me at my email. Once again, thank you. Have a nice day.